Welcome to the Big Mike Fun Podcast, where you'll learn about advanced wealth building strategies from real estate investing to creating massive ROI and secured retirement profits. So pour yourself a cup of coffee, grab a notepad, and lean in. Because Big Mike has got the mic, starting now.
Welcome to the Big Mike Fun Podcast. I'm the Big Mike Zlatnik, and today it is my pleasure and a privilege to welcome my old friend, Corey Peterson. Hi, Corey.
What's going on, Mike?
Corey is known as, I call him Big Kahuna. He runs Kahuna Investments, and he is a distinguished gentleman. He's done a lot of investing in multifamily. He runs a multifamily empire. He has been a guest on multiple channels on Fox, ABC, CBS, NBC. He was a guest and speaker at Harvard University as well as NASDAQ. He's written multiple books, as well as he has a podcast called Multifamily Legacy Podcast. So I am honored and humbled to have you here. Thank you, Corey. And what's new in the world of Big Kahuna?
Man, it's crazy. Right now is a crazy time. There's lots of change going on in the marketplace, and we are adapting to some of the conditions, which is the higher interest rates, and overall we've weathered the storm, right? Things are changing, but the great thing about this business is that you have options, and I think, and the levers, where traditionally in the stock market, Mike, no one has any levers. They have no options, right? You get what you get. And with this thing called real estate, we have a lot more flexibility. And so we are flexing right now. We're pivoting because the market has shifted, and so we have to shift with it. I think that's the status quo, is staying ahead of the shift.
Yeah, and I appreciate you bringing it up. It's on everybody's mind. The reality is these rapidly risen interest rates have drastically shifted the environment, and we're dealing with this very painful reality. So
fundamentals are still there, though, Mike, right? And that's the one thing I always like. Even though we've had some, it's not that the interest rates went up; it's that they went up so violently that's what caused things to break. We could handle it if it was just slower and steady. I think that's, as operators, we're very normal. That's a normal course of what goes on. But it was the violent, acceleration of the raise with that, and that breaks things, right? And so
I have a term for it. Just like the movie, the interest rates went up too fast and too furious.
Yes, fast and furious. And so when that happens, Mike, it's like all hands on deck. And so just for complete, I'm going to give it to you real. Can I give it to you guys real?
Yeah, absolutely.
I don't know any other way to do these types of podcasts except to talk about my own business and share the good, bad, and the ugly. So fundamentally, though, there's still a demand for housing. Like, that's not changed, right? It's just the environment and we're playing. So values have changed, operational efficiency has changed, and so everything that you currently had, you have to now tighten the belt, right? And so, to me, that's what we've had to do internally, is because even though we have lots of our properties have rate caps, because we had the same types of loans that everybody else was doing, which was bridge loans. 3 years ago, we were all doing bridge loans. And right. I've got a lot of bridge. Now, most of those bridge have cap locks, right? Cap rate locks. And so, but you were at 4%, and now you're at 5.75, which is your rate cap. And so the rate caps, even though on those bridge loans, the rates are like 8.75, almost 9% on some, I'm still capped at 5.75, which is good. We bought those rate caps initially for $40,000. They've paid out really well. There's a caveat, though, that rate caps are going to run out one day. And knowing that date and time is critical. And then also understanding what you got to do to either bring on new debt, right, to get into a fixed rate, or get yourself to operational efficiency, so you can be able to be able to get to that place to get new debt. That's been the challenge, right? I think, and that's where I see a lot of operators now are really having the challenge, and we did too. And so the thing that we've done this year that I said I would never do it, Mike. I said I would never manage properties. I would never be in the property management business. And I feel like it's the Godfather story, Mike. As soon as I got out, they pulled me back in, right?
Right.
So we vertically integrated this year. We took all property management in-house and developed our own accounting staff, our team. It was a lot of work to do it because we want to do it properly. And the good news is we've got a big enough portfolio that we can afford to do it. We can afford to hire all the people. But here's what we found is we found that we became much more efficient, much more efficient. And the only reason for that is we watch the money, right? Third-party property management companies, God love them, but they do not have a vested interest as you, the owner operator. And because they get paid regardless, just based on collections. They collect this much money, they're going to get their percentage or fee. And then they'll figure out ways to charge you back for every little thing they do. And those expenses add up, Mike. They just do. And so when we pulled back the layers and we brought it in-house, we realized that we don't need that. We don't need this. This is inefficient. We started looking at ways like, let's change the phone. Do we, we're on some properties, and this sounds like not a big thing, but these are places to find money. We're spending on one property, it was like $350 a month for phones, telephones. I'm like, why are we spending $350 a month on a stupid commercial line? Let's go get Ring Central, right? And so we did that, and now we're paying like $150 a month instead of, we saved 50%. Now, not a big deal, but you start finding those little values all throughout all your stuff, and it starts making a huge impact. And I think operational efficiency is the way we win in 2023, is to be lean and mean.
Lean and mean. I appreciate that. That's a great great coined term, but let me dive into everything you said. You said a lot of very interesting things, and they're all very applicable and very, very true in this environment. So first of all, most of the value-add multifamily operators, and not just multifamily, other asset classes, bought these properties with bridge loans. So the problem is not unique to you. It's actually industry-wide. In fact, probably 95% of all these value-add loans, variable rate loans with rate caps. And you're sitting a lot, not just you, a lot of investors are sitting on time bombs when these rate caps expire, because you go from 4% rate to 9%. You could manage a rate cap at 575. Most folks can survive, but most folks cannot survive rates going to 9%. It's going to be very, very tough, at least, for maybe a short amount of time.
Yep.
The other comment that you made, which makes a lot of sense, it's the race right now to stabilization. So you have to execute way, way better, way sharper to get the property to complete the value add plan and to be able to refinance the property into Fannie Mae, Freddie Mac agency debt. So all the stuff you said makes a lot of sense. And then a lot of operators discovered exactly what you discovered, where there's a third-party property management, they do a terrible job. And especially if they're not in the same city and you're not paying enough attention, that property management business got a whole lot harder. So what I wanted to dive in a couple of things. One, where are most of your properties? Do you have concentration in certain cities? And are you developing?
Don't, unfortunately, right? So we have properties. We do a lot of student housing. So we're in 70% of my portfolio is student living, right? Where we butt up next to colleges and we rent by the bed, right? So I feel like I got hit with a 1-2 punch. I got hit with COVID, right? Because when people didn't go to school, they didn't go to stay in the properties. And then coupled with the right cross was high interest rates. Now, luckily on most of my student homes, we put long-term debt on, right? We didn't do much value add big projects like that, but I still had two. I have two that we have like that, and so unfortunately, I can't scale that way, but we still can. But we still have to be efficient, right? And so the property management piece for that is then utilizing online technology such as Zoom, conferencing, Slack, right? Communication styles. We have created much more centric internal talking. So the biggest challenge on the way we have operated in the past, or at least with different property management, is every property was on an island. I mean, I would go there like, I get no support, right? And we're like, God, why can't even these property management companies figure this out? So the first thing that we did when we took over integration and property management was to get everybody on Slack. And Slack's not new, it's old. Probably most people do Microsoft Teams now, but I'm still stuck in my old school ways, so I like Slack. But created channels for all my team members and property managers to communicate, because if one's having a problem, they probably all have the same problem, right? And sharing ideas. And believe it or not, property management is the people business. That's really what we do. Now, the primary focus is leasing and collections. If we can do those two things, we win, right? Lease the property up, collect all the money. Seems simple, but it's a lot harder in reality. Okay. But having a team and people, so we've learned that if we invest in people and teach them and train them, and more importantly, the first thing that we did, Mike, is when we took over, we brought all the property managers here to Phoenix, to my corporate, and I instilled culture. We talked about who we are, what we are, how we're going to do it, how we're going to be different, how we're all a team. And then I set out and we did some fun team building exercise. We actually got in my Jeeps. We went rock crawling. We scared the living crap out of everybody. But we built a team, a nucleus. And by doing that, we were able to go back to our properties, and now everybody was talking, right? And that made execution of new projects and plans so much more efficient and so much more effective.
Yeah, I appreciate great wisdom. You certainly have done a great service by installing the right culture and making sure you have good people. There's a good book that I'm sure you've heard of it and you've read, called CEO Does Only Three Things, by Trey Taylor. People, culture, and numbers. And you covered two elements here. You covered getting good people and getting the right culture and providing the right standardization and systems and processes for them to operate. But property management is always harder than it looks. It's in the past few years, it was assumed it was just going to happen. Unfortunately, as things got a lot harder to execute, you don't have a choice. If you don't do it, these projects can't succeed. So at the end of the day, it's all about.
Then it's about capital improvements, the CapEx dollars, right? Spending your dollars, doing the actual work to renovate. You almost have to have an internal construction management component to your property management side. That's what we're doing now, is we're building out that piece too, because we've had third-party property construction management companies help us, and I feel like I get the same process with that. So that's our next efficiency lever that we're going to pull. Is I won't say that we'll create a construction management company, but we will definitely get way more involved and hire staff to start taking on the next big projects that we have. We will have an internal team to handle that and to manage that, to be, again, more efficient, to eliminate waste. Because when you think about waste, like it can be really rampant. If you're buying different, you can buy the same toilet, right? 5 different properties, buy a different toilet. You need a toilet. Well, what's the right toilet to buy? And toilet prices can be, there's a big range in high price, value, lowest price. What is the right one? And it seems like that's not a big thing, but like, again, these are understanding the efficiency of making sure everybody's playing from the same playbook, that we have the same systems, is truly what makes that's when I talk about operational excellence, that's what we talk about, right? Is making sure those little things, those are the big things.
Yeah, Corey, I agree with you 100%. We do business with other operators who are vertically integrated, large operators, and that's what they do. I mean, you got to have vertical integration, which includes construction management, obviously your own crews, property management, which is both obviously leasing, accounting, obviously solving whatever maintenance issues, and then all of this has to be vertically integrated. And even though you're not all in the same markets, but whatever economy of scale you can achieve, you must achieve. Without it, the game becomes very difficult. And then supplies, like you mentioned, buying supplies. Can you buy supplies in scale? Can you buy?
Can you buy in bulk? Yes.
Yeah.
Can you? Where do you store it? Where do you put it? Right. All these things, they're all factors that just lead to, a bigger picture. And again, I think these are the things that operators have to really be paying attention to in 2023, where we're at today. All these things that we're talking about right now, Mike, they matter. They really do matter, because we are not immune to any of this as well. Like this year we had our first capital call, right? And that was not fun. It was horrible, right? And that used to be the death of a syndicator, by the way, right? Capital call would be like, you get blacklisted. Now it's kind of like par for the course. Everybody has had one, I think, that I know of. And if they've not said it publicly, they have. They just don't want to say anything, right? I'm not hiding from our flaws, because we're not perfect. And this is what I talked about in the beginning when I opened, Mike, is that I used to be a financial advisor. And I remember 2009 when that market crashed, Mike. I remember people coming to my office. I was like, it's the market. There was nothing I could do. I said, you know what? It is what it is. Sorry, your $3 million is now 1.5. What do you want me to do? Right. And with real estate, what I'm saying, what I realized back then is I had no control. There was no things that I could fix or adjust to try to right the ship. Right. It was just like, it's the market. Good luck. Let's hope and pray and wait till the next upturn. And hopefully you're in the right fund and it'll work. Which most people at that point, they say, sell me out of that. Put me in cash, which is the worst decision for them. And so, but with real estate, here we are, markets changed. And so we've had to pivot. Yes, we have to pause distributions on a lot of properties right now. I think a lot of operators have paused or diminished or reduced their normal payout. Why? Cash is king right now. What's more important, getting a distribution or making sure you're solvent so the project doesn't fail, right? Because at the end of the day, this is the hardest thing for investors to grab a hold of. This is a short-term problem on a long-term deal. Most of our deals are 5 to 7 years. And so this is a blimp in the current place. Do we think it's going to be forever? I don't believe it will be. Could it be the next year and a half? Probably, right? But, we're having an election year coming next year. I see, 10 on election year, everybody wants things to kind of start working again. And, we'll see what the Fed does. But I think the money supply, or like the change in the Fed, will start. At least I think they put a ceiling on it. And as we start to see that coming down, you're going to see lending coming back, and we're going to see deals coming back again, right? That's my belief now. But I'm trying to play chess, right? And people are somewhat worried about checkers, like, oh, let's just make this one jump. And I'm like, no. We got to look at the bigger picture. Our goal is just to get through this short-term period, because we're trying to checkmate down the road, and we got to get in the right position to be there. And so that means we have to operate correctly, right? And I think that is the story. If I could send to most people out there, when you're listening to investments, this is what you're looking for in operators, is the ones that understand what they're trying to do and making sure they're making the right changes. And it may not always feel good, but that's usually the right move. If it doesn't, they're doing it for the right reasons, and they have to be honest with the investor pool and not give them a bunch of fluff.
Yeah. First off, thank you for sharing, and everything you said makes really good sense. I concur with you in the things you mentioned. The capital calls are not fun. The projects that need liquidity need typically cash can only come from a few sources. Capital calls, one of them. Two can be in the form of some kind of additional bridge debt. And people have gone both routes. If they can't get the money in the form from investors in the form of capital call, they have to go to bridge debt or fresh preferred equity. And as the result, the projects, if they don't raise cash, the projects fail. I mean, at the end of the day, this is a game of survival. So everything you said makes sense. Can you survive through the end of 2025? And that's the theory, that most deals that will persevere and survive to the end of 25 will have a chance to survive. But I think it's not just the time exercise, it's a race against time versus your rate cap expiration. So critically important to understand when the time bomb is out there, when you have expiring.
And I want to bring up,
if you can refi, you can survive with fixed rate Fannie Freddie, then you live until, you live another day, and then you wind up, the time will take care of all the issues. And most investors today will actually understand if you suspend distributions. That's the least of the problems. If you just suspend distributions, that's half the problem. Most of them are facing situation not only suspend distributions but also capital call, and if they can't do capital call, where else money's going to come from?
Yeah, exactly. Or the project
dilutionary fresh capital. I mean, at the end of the day.
Yep. You're going to have to dilute now. So I'll give you an example. So here's two projects that where you've got right now, and I know we're almost out of time. So, but like we had two rate caps on student housing properties that what they normally these bridge loans, they have a guaranteed minimum interest, right? So for us, and as on this one deal that we have, the guaranteed minimum interest, because interest rates keep going up, so our guaranteed minimum interest keeps going up as well, because they base it on today's rate versus what where it was a couple of months ago. But anyways, so we have two projects that we have these cap rates. One is good till February of next year, and then the other one is till October of 24, which is a great one, right? But I get a daily, not a daily, but like every 3 days, I get a valuation on these rate caps of what they're valued at, right? And they're valued around $400,000, 4 to 5.
You could sell a rate cap if you can refi the asset. The rate cap becomes a valid contract you can sell for a good amount of cash.
Yeah, so we are looking in August. So we have these two refis, which we're going to be able to put together. Why? We operated our business plan, right? We did increase the value. We increased our occupancy. We made our numbers better, right? In one case, much better, and the other one, better enough to refi, right? And better enough just to refi and to fix debt is a absolute win, right?
Yeah.
So because we will get into 5.7 rate right now, the fixed rate is about 5.75, because it was almost 5.5, but lately the sulfur, whatever, it's up a little bit more than it was. Hopefully, by the time we refi, that goes down a little bit, and that would be amazing. But even at 5.75, it's what we're in our rate cap lock for now, and that works for us, right? We can live and survive. Now, what will happen, though, is once we refi and get rid of that debt, then we can sell that instrument, the rate cap, for $400,000. Boom. Well, that's extra money. We're going to put that in the forever fund, right? Let's just keep that in cash reserves now. So now we have a little bit of cash extra reserves, which every property I think needs right now. Whatever we thought we had, we need to add more, because it is agreed survive to 25, right? Get down the road a little bit more. The great thing with Freddie and Fannie is we sell supplementals. If we can get those types of loans out there, like that's how you can have another exit for your capital that way. Or eventually get to a place where we can sell the project entirely, right? But what I didn't, so the caveat behind all this is those rate caps that we bought for $30,000 or $40,000. Some of them are worth $500,000, right? And so if you can get to operational excellence where you can refi, when you find that permanent debt, that's a nice little golden parachute that you didn't really realize you had. And man, whew.
Yeah,
finding ways to win today is the that is what we're tasked to do, is find ways to win. And again, that's the levers that we have in real estate, thankfully. Because I know when I was in financial advisors, I had no levers.
Yeah, and everything you said makes a lot of sense, and I appreciate you sharing it. Obviously, rate cap is a liquid instrument. You could trade for sure, and you can get additional capital for the project by selling it. But at the end of the day, it's a race to stabilization. I mean, at this point, there's just no higher priority than operating these properties well and get them to full stabilization. You can refi with the agency debt. So, and yes, you have a few controls, but without good execution, none of this connection.
You got to have the operational piece. That is the foundation of it all, right? No bank's going to lend to something that's 80% with, delinquency, right? Or like, you have to have, it's basics, right? These are back to the basics, but you've got to button up all your rehab. So one of the things we did on one project, right? Just another quick deal, is we were doing lots of rehab, and we finally said, hold on, because there was too much of a delta between doing rehab, getting people moved in and moved out. And right now we need all the money. So we're like, pause rehab for a bit. Let's fill up the property. Let's get to 97, 95%. And then let's turn back on rehab a little bit, right? Just like, let's do a couple units. We can't go to 80% vacancy with all the rehab units, because we can't afford to anymore, right? Like, you've got to be so tight. And so that's the name of the game, is, okay, we don't need that delta anymore. You could get away with that. Right now is not the time to get away with that. It's the time to be very, very sound and methodical about what rehab, what projects you're doing, and how quickly you turn. It's about efficiency. And again, Mike, you said it, and that is it. You've got to maximize operational efficiency. If you do that, you can find ways to place new debt. It's still expensive. The silver lining, though, is on the buy side, Mike. When you talk about that, is if we're buying new projects, there's still a lot of people that have to sell. Lots of people, and this is happening right now, right before our eyes. Cap rates are coming due, these rate caps, and there's to get a new one that the loans require is $1 million. No one's going to put $1 million to buy that cap rate. They're going to sell. They're going to have to sell, and they'll sell just to get out all their capital to break even. So I guarantee there's going to be some projects that you can pick up, because the sellers are forced to make a decision because they didn't hit their business plan effectively. And now it's about just preserving their principal is all they're trying to do. They're not even trying to make a profit. And you can pick up a project like that. And those are the projects that we're looking to buy.
Yeah, I agree with you. So everything you said before was about survival. And now you're going into an opportunistic thrival mode. So how to thrive in this environment. And that's all about getting great deals from distressed
understanding sellers. When do you buy? You buy when the blood's in the street, right? So I got to protect what I currently have, like a bear. I'm very much anything we own currently, operational efficiency, right? But then I've also got to understand, when do I make the most value on the buy? Is it time to buy? Feels like it's starting to be a pretty good time. If I can get it now and it makes sense with the current rates, and rates go down, I get a bonus at the end, because I'm not going to put that in my underwriting. I'm going to act like it's not there. But if it happens, good for me.
Corey, I concur with you 100%. I've been saying this the same way you're saying this. The opportunity to buy real estate is when the rates are high, and the rates are high on a cyclical basis. So whatever the Fed does, and then another quarter or two increase, which is almost this point immaterial. They've already done all the damage, and the damage pressure is coming from the time bombs that mature and folks need to sell if they or buy a new rate cap, or the project goes into a default. So exactly, are you seeing investors? This is a kind of a follow-up question. So great opportunities are coming to buy now if you can get a distressed seller, right? Distressed seller, quality asset, they have to exit, otherwise the project is going to go into technical default. Now, fresh capital, that's the challenge is a lot of investors are not getting exits the way they were getting exits before. So now there's a shortage of capital to be put in new deals because the old deals are not exiting, or if they're exiting, investors are just happy to get their money out, and some are going to leave the space for a while just because they thought it was easy money for a while, and now making money business in real estate's got somewhat harder.
Yes.
So fresh capital, are you seeing fresh capital flowing? Investors are kind of hoarding and saying, Corey, I'm ready to go.
Fundamentally, yeah. Mike, this is where I differ than most indicators out there. I do not raise money from smart institutional investors. Okay. I raise money because I was trained classically as a financial advisor. I get money from people that have money in the stock market, and they're getting bloodbaths in the stock market as well, right? So most of my investor pool, they still want more options, and so they look at me as it's a little different. Now, is it great? It's a little bit more work, Mike. Right now, it's more work to talk to them and understand it. But I think fundamentally, people say, "Hey, things are not great," and so you walk them through that. The ones that have been in the stock market, that are coming fresh into a syndication, they know they don't have those battle scars, right? And so I find that they're more apt to deploy capital. And then with your existing pool, yes, they are slow now to deploy, right? And quite frankly, we're looking at different asset classes too, right? It's like, who's moved my cheese? We're also looking at self-storage right now. Self-storage has been pretty resilient in down markets, right? So and now we have, and I think that's investors now want they want to be spread out in more different asset classes. It used to be, yep, I just want apartments. That works. It works for me. I know it's a basic need. It works. And fundamentally, that's still great opportunity. But like, I've got some friends that are doing a car wash model, right? They're doing, the express car wash. I've got other guys that are doing self-storage. We're looking to add some self-storage to our portfolio and honestly kind of give our investors a couple different blends, so they're not just in one asset class in one market, to have a little bit of flexibility. I think at the end of the day, the right ones want flexibility. They want to be in a little bit more diversified projects. But what I think is the most important is they look at the operator, right? The operator, and being able to tell these stories and have them call your investors and say, this is what's going on. Now, at about 3 years from now, when I come out of this thing and I sell some of the ones that we have exits for, I'm going to be a fanboy. I'm going to post all the stuff, right? And be like, here's the challenge that we went through and we exited. To me, those are going to be the stories that I'll hold on to, because that's going to be the stories every investor is going to want to hear.
Yeah, perseverance. Now, it's a game of the fittest, of the strongest and the smartest, and those who work the hardest now. And yes, this work will, in theory, produce the results a few years from now, where you can tell the story, look back, and say we survived, and now we are thriving. And what you just said, I mean, I've been saying this for a long time. When we run, as you may know, family of diversified funds, and during the days when market was great, everything was going up, people took risks and they felt great about it, and our funds looked kind of boring. Now, the funny thing you said, having a diversified portfolio is much more critical in a market that's that shows signs of instability, signs of risk, signs of diversification as a way to mitigate risk. So
Amen.
Everything you said has been music to my ears because we've run this model for a long time, and having diversified strategy makes a lot of sense because you just don't know what's going to get hit and what's going to be a home run and what's going to be a strikeout. So I appreciate you sharing this because I agree with you. It's kind of funny if you go through the real estate cycles, and then there are 4 cycles for every asset class, and it's recovery after recession, expansion, then hypersupply, and then recession, right? We are sort of during the hypersupply. We've entered effectively hypersupply for most asset classes, including multifamily. And in hypersupply, one of the key things that you observe is higher rising interest rates, which we've seen. And 2, you see diversification. People have to diversify to protect themselves against a down market. So that's been, I appreciate you sharing. It's the same, very same thoughts here.
Fundamentally, that's what we look at as we are getting better and better at our craft, right? We've realized we can't be just the one-trick pony. We need to have options, and I think investors want that more so than ever, and that's rightfully so, because when the tide goes out, like it has, you realize who's naked, right? And you do not want to be that person. You want to make sure that we're doing our best to survive and thrive, to make the pivots that are needed. And then again, but it's still a wonderful business, Mike. I wouldn't trade it for anything. I love what we do. I love working with investors and that whole process, because what other choices do they really have? The stock market where no one cares, or people that like us that are really constantly worried about this stuff and watching it. I guarantee we think about it a lot harder than a lot of people that I know. And to me, that's why we're successful.
Yeah, I appreciate it, Corey. I concur with you. Of course, the stock market has no, limited predictability. Real estate does, but real estate is not immune to cycles. And a lot of investors in the last few years just got accustomed to perfection. And then unfortunately, market from time to time does what it does, and these cycles come in, and we're experiencing this cycle. And for those who have long-term perspective, they'll be just fine. And real estate, like you said, is really a long game.
It is.
So most of the real estate is a long-term play. Whoever thinks it's short-term, they are either mistaken, or there's certain short-term investments, right? But most of the investments are really, especially equities, fundamental long-term. And if these assets are managed well, they can do well on a long-term basis.
They'll thrive when it comes back around, right? And that's the whole point, right? And it's important not to lose focus and to educate the investors on what that focus is. And I think that's what we got to try to do as managers of our syndications and your funds, is to lead by example. Let them know that Rome's not burning. Yeah, we're taking some hits, but we've not, we may have lost the battle, but we're not lost the war, and we're setting ourselves up to ultimately, prosper. And I think that's the difference between, you and your fund and your guys' strengths and what you look out for. At the end of the day, you're really trying to provide value, confidence, and and a return that most investors want and need.
Yeah, Corey, I appreciate you sharing it. A lot of great nuggets, a lot of wisdom. And thank you for being very open. May not be a very comfortable conversation. Some people want to hide in the closet, but those who are open, communicate well, do the right things for investors, these are the folks that'll survive and succeed in the long run. So thank you for your honesty and for your openness. So appreciate you coming on the podcast. Before we're done, how would folks get a hold of you if they want to reach out? KahunaInvestments.com, any other website?
Yeah, well, actually, I'll give them. I've got a book that they can get. It's called "Copy Your Way to Success: Standing on the Shoulders of Giants." If they'll text the word "book" BOOK to 480-500-1127, my team will ship them a book for free. So that, and then Multifamily Legacy Podcast is a great place to learn about the power of apartment investing and what we do there.
Thank you, Corey. Thank you for sharing. I appreciate your wisdom. And good luck Hey, good
Thanks,
luck for all
brother.
of us during the next couple of years.
Hey man, it's I'm excited, and I'm really the opportunity is what I look for, right? I try, we all have assets we got to protect, but I also learned that it's looking for the future that really matters, right? And so understanding where we're at, and we're in a great spot.
Yeah, I concur with you on a final note that the forward return opportunity on fresh money is significantly better than the last couple of years. Because last couple of years, let's just call them peak of the market, and you can come in into distressed sale at the right price with high interest rates. You have nothing but the upside when the rates cycle back down. So
there we go.
Thank you.
All right, man. Thanks, buddy.
Thank you for listening to the Big Mike Fund Podcast. To receive your copy of Mike's How to Choose a Smart Real Estate Fund book, head to BigMikeFund.com or visit Amazon and type Mike's slot name. Keep listening and keep investing Big Mike style. See you on the next episode.